Hello, and welcome to AI Market News by LM. Before we dive in, a quick disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, with that out of the way, let's get to it. Wall Street is just on fire. It seems like every single day we're hitting new highs, pushing further and further into record territory. It really feels like a party that's never going to stop. But what's really going on here? What's the fuel for this incredible momentum? And maybe more importantly, are there some big risks on the horizon that the market is just completely ignoring? Let's break it all down.
Okay, just to give us a sense of scale here, look at this number, 28. That is the number of times the S&P 500 has closed at a brand new all-time record high just this year. I mean, think about that. This isn't just a good run. It's a relentless climb that almost seems to defy gravity. And you know, this creates a really powerful feeling in the market where that fear of missing out, that FOMO, it starts to feel a lot stronger than the fear of actually losing money. We see it in sentiment trackers like the Fear and Greed Index, which has been flashing greed or extreme greed for weeks now. It shows just how confident, maybe even a little complacent, everyone's getting. This isn't some small blip. It's a full-on bull run, and it's got everyone wondering not if it's going to end, but how.
And when we pop the hood and look inside, we see that this rally, while definitely led by tech, is actually pretty widespread. The S&P 500, which is our go-to benchmark for the whole market, is obviously hitting records. But the real engine here, the superstar of the show, is the tech-heavy NASDAQ. That's where all the AI giants live, and its performance has been absolutely supercharged by this, well, AI exuberance. What's really interesting, though, is that even the Dow Jones, which is more of your traditional, old-school part of the economy, is also posting really solid gains. That tells us the good mood is spilling over, like a rising tide lifting all boats. But let's be real, there is one story at the absolute center of this market earthquake. And that brings us to the real heart of the matter, the core driver of this whole thing, a massive $100 billion bet on the future of artificial intelligence. Now, this isn't just a couple of hot stocks doing well. This is a tidal wave of cash so huge that it's fundamentally changing how investors think, how they value companies, and it's forcing literally everyone to ask, do I have enough skin in the AI game?
We're seeing this idea captured perfectly in headlines from all sorts of news commentary. The story on the street is simple. Big tech, with its AI firepower, isn't just the next big thing, it's the only thing that really matters for growth right now. This feeling is so strong, it's creating what they call a halo effect. It's not just the AI companies themselves that are soaring, no, it's the entire ecosystem around them. We're talking about companies that build the cooling systems for the data centers, the utility companies that supply the insane amounts of power they need, even the software companies building on top of these AI platforms.
And here is the number that's at the center of it all, $100 billion. That's the number being thrown around for NVIDIA's planned investment into OpenAI. Now, what's really going on here is a strategic partnership. NVIDIA is set to provide the capital over time, starting with $10 billion, and in return, they get a piece of OpenAI. I mean, it's a number so big it almost doesn't sound real, but its impact is huge. A deal this big is a massive vote of confidence. It's a signal to the whole market that the biggest players aren't just coasting. They are all in, tying the king of AI chips directly to the king of AI models.
Now, what's so brilliant about this deal is that it creates this perfect self-reinforcing loop. So first, that cash goes directly to building out these enormous, power-hungry new AI data centers. We're talking a goal of 10 gigawatts of power. That's enough to run a city like New York. Second, and this is the genius part, who do you think is going to supply all the chips for these new data centers? NVIDIA, of course. They're basically funding their own biggest customer, locking in their dominance. And third, this massive show of force just validates the whole AI story, which boosts investor confidence and pulls even more money into the sector. It's a beautiful cycle if you're NVIDIA. So while the AI sector has its foot slammed on the accelerator, the one institution that's in charge of the whole economy's speed limit, the Federal Reserve, is having a pretty serious argument about whether to hit the brakes. And this creates this incredible tension, right? A real tug-of-war between tech's wild ambitions and the Fed's economic caution, and it's all playing out right in the middle of the market. So what's the argument about? Well, on one side, we have this new and pretty loud voice, Fed Governor Stephen Barron. He's what we'd call a dove. He's basically saying, hey, our policy is way too tight right now, like 2 full percentage points too tight. He's worried that if they keep the brakes on for too long, they're going to do real damage to the job market. But on the other side, you have the hawks. These are the folks who still have nightmares about the recent inflation surge. And they're worried that if they cut interest rates too soon, that inflation monster they just fought so hard to put back in its cage is going to come roaring back. And Miran isn't being shy about this. You can really feel the urgency when he speaks. When he says it's better to move more quickly, he's not just talking about one little rate cut. No, he's openly said he wants to see a series of big 50 basis point cuts, that's double the usual move, to get policy back to a normal level before it starts hurting jobs. So this isn't just a minor disagreement, it's a completely different view on what the biggest risk to the economy is right now. Now, this isn't just some academic debate for economists to argue about. This uncertainty at the Fed causes real volatility, especially for the US dollar, which then sends ripples all over the world. For anyone trading currencies, this is a huge deal. If Miran and the Doves win and the Fed cuts rates hard, the dollar would probably get weaker. That would push something like the EUR/USD pair higher. On the flip side, if the hawks win and rates stay high, the dollar gets stronger. That could put a ton of pressure on other currencies, like the Japanese yen, maybe pushing the USD/JPY pair to new highs and causing headaches for the Bank of Japan. The whole world is watching. Okay, so let's zoom out a bit from just the US, because while Wall Street's having a party, there's another major global group that's starting to sound a very different kind of alarm. And this is where the story gets a little more complicated, because these risks they're flagging, well, they're just over the horizon, in a place the market doesn't seem to be paying attention to at all. We're talking about the OECD, the Organization for Economic Cooperation and Development. You can basically think of them as a big economic think tank for all the world's developed countries. And their latest report has this really interesting contradiction. They're saying things look better than they expected right now, but they see the future as being a lot more dangerous. It's kind of like saying, enjoy the sunshine today because there's a storm coming tomorrow. And on the surface, the news looks great. The OECD actually bumped up its global growth forecast for 2025 from 2.9% to a much healthier 3.2%. They did the same for the US, and they specifically pointed to all that strong AI-related investment we've been talking about as a key reason why. So this suggests the global economy is actually holding up surprisingly well, despite high interest rates and all the geopolitical stuff going on, for now anyway. But here's the turn. The OECD's chief economist gave this really stark warning about trade tariffs, saying the full impact hasn't even hit yet. He said, flat out, that this rise in protectionism is a significant blow to the US economy, and that the negative effects are going to ripple out and drag down global growth. They're actually forecasting a noticeable slowdown in 2026, driven by these tariffs, a risk that the stock market, in its current state of euphoria, seems to be completely ignoring. It's a direct challenge to the optimistic story driving prices today. So what we have here is a classic tug of war for the market. On one end of the rope, you've got the incredible, powerful, forward-looking pull of the AI boom, promising this whole new world of profits. And on the other end, you've got this heavy economic drag from a divided Fed and these storm clouds gathering over the global economy. And this brings us right to the key question we all have to ask ourselves as we look at the market. So let's lay it out, the bull case versus the bear case. The bulls, the optimists, they believe this AI thing is a real revolution, a game changer that's going to power profits for years, maybe decades. They also think the Fed is going to have to cut rates eventually, which will act as a nice safety net for stocks. The bears, though, see a totally different picture. They're looking at that stubborn inflation that just won't go away and a job market that's starting to look a little weaker. They think the Fed might get backed into a corner. And they argue that the market, high on its AI dreams, is completely ignoring the real risks of a global slowdown and the damage from those trade tariffs. So how will we know which side is winning this tug of war? Well, we need to watch the data. Checking the economic calendar on a site like investing.com, the next huge one is this week's PCE inflation number. PCE is the inflation gauge the Fed really cares about. If that number comes in hot, it'll give the hawks more ammunition. If it's cool, the doves will feel a lot more confident. And then after that, all eyes will be on Q4 earnings season next month. That's the real test. Can these companies, especially in tech, actually deliver the kind of mind-blowing profits needed to justify these record-high stock prices? And that leaves us with the big, multi-trillion-dollar question. Will the incredible forward momentum of the AI boom be strong enough to power through the very real economic drag we're seeing from inflation, from an uncertain Fed, and from global trade problems? Right now, the bulls are definitely in charge. But the final outcome of this epic battle between a powerful story and some hard numbers is anything but certain. Thanks for watching. Don't forget to like and subscribe.